There are ramped up expectations now for an aggressive U.S. Federal Reserve easing cycle. And of course, that's after a super aggressive increase in interest rates over the past 2 years. Economists at many of the big banks in Canada and the US are revamping their forecasts for US monetary policy after data pointed to the US unemployment rate hitting its highest in almost 3 years. Our guest says one or even multiple half percentage point cuts, 50 basis point reductions are now on the table. We're joined by Gennadiy Goldberg, head of US rate strategy at TD Securities. Gennadiy, thanks very much for coming on the show. September 18th, we're expecting the Fed rate announcement. Do you think that could be a 50 basis point cut? Not sure if we lost.
I think it's not our. We did revise our forecast for interest rates to actually pencil in more than the number of cuts that we had before. But we're still not expecting a 50 in September. We're expecting a 25 basis point cut, but 50 is tough to take off the table simply because the labor market is starting to soften. But I do think markets may be getting a little bit ahead of themselves, and we'll have to see more data to figure out if the Fed should be going 50 or can actually start to cycle a little bit more gradually than the market currently expects.
Is this typical in history, though? Do central bankers usually fail to engineer the so-called soft landing?
It is, unfortunately. I mean, the saying goes, escalator up, elevator down for interest rates. And, this is really what the market is starting to price in is a harder landing, or I should say higher odds of a harder landing than we were pricing in before. Now, the data will tell. And even some of the dovish FOMC members have pushed back. You saw Austin Goolsbee come out after this payroll print and actually say, well, let's wait a second. We're not reacting to every single data print. But of course, everything's on the table. And we can't rule anything out, but we'll have to wait to confirm that this is truly the start of slowing.
Why would they not go 50 basis points on September 18th? Would it be too much of a loss of face for them, having delayed cutting?
I think the biggest problem with going 50 right off the bat is that, you've missed something. I think it's the equivalent of really pulling the fire alarm at the Fed, and they're reluctant to do that. Now, certainly they will if they feel the need. But if you look at it from the Fed's perspective, jobless, payrolls are 170,000 a month if you average them out over the last 3 months. Mm-hmm. And in reality, what you're really seeing is not that much deterioration, certainly a weak print here, but it could have been influenced by the weather. There were a lot of people out of work due to Hurricane Beryl, and we'll have to see if that data actually holds up.
And I saw a headline today that the U.S. labor participation rate has been climbing. So there's a lot of people either working or looking for work. And I guess that tends to inflate the unemployment number.
Exactly. So what happened this month is effectively you had more people enter the labor force than there were jobs created. So typically we would say this is actually the unemployment rate rising for good reasons. Unfortunately, now we're actually not seeing enough jobs created to provide employment to all the workers entering the labor force, and that is pushing the unemployment rate higher. Now, again, that could have been influenced by some of the weather dynamics, and I wouldn't be surprised to see the unemployment rate snap back a little bit next month. But this does create a risk that perhaps the labor market is slowing more than the Fed was expecting, more than markets were expecting, and that's why you saw these enormous moves in the rate market today.
Just remind me, let's put up the U.S. 10-year bond yield. So what have we been seeing in the bond market right now?
So what we've been seeing is the market already reacting to somewhat weaker data. We've seen inflation really come to heel. We've seen labor markets, even last month, start to decelerate. Now what we've seen is this labor market print basically pours fuel on the fire and has driven markets sharply lower. In fact, we're now pricing in, or the market is pricing in, more rate cuts than they have been since the Fed stopped hiking interest rates. So more even than after Powell's dovish pivot in December of 2023. So the market is very, very aggressively priced for cuts. And it's just a question of whether the data justifies that yet or not.
We're just looking at a chart for the US 10-year bond yield over the past decade. And I mean, we had that near free money for so long. People were willing to tie up money for 10 years at a 3% annual yield. But I know we're going down, we're below 4% right now. When you see bond yields dropping, though, Gennadiy, isn't it a sign that a lot of investors are not so concerned about inflation?
I think so. I think what we've seen is the market's focus really shift from solely inflation to now inflation and the labor market as well. We've gone from kind of single mandates back to the dual mandate in spectacular fashion. The markets are convinced that inflation is back under control. I think the Fed is almost convinced, and they told us as much in the July meeting. But at the end of the day, it's now really up to the labor market to decide just how fast the Fed will cut. You know, that's why we're looking for a 25 basis point cut in September and 25 basis point cuts all the way until they get to 3% by November of 2025. So relatively rapid cutting cycles, slow historically, but far from slow given the current context.